welcome back to Boni's Life, the channel where we navigate the beautiful, chaotic, and often downright baffling world of financial markets with a little bit of wit and a whole lot of data. Today, we're tackling the question that's on every trader's mind, from the seasoned hodler to the Deegan who just aped into a coin named after a cat wearing a hat. How in the world do we trade this market? We're in a fascinating and, frankly, a slightly schizophrenic period. 1 minute, the headlines are screaming all-time highs. The next, it feels like we're about to fall off a cliff. So, what's the real story? Is it time to go all in? Or should we be running for the digital hills? Well, grab your coffee, silence your notifications, unless it's me, of course, because we are about to dissect this market layer by layer. We'll identify exactly what kind of beast we're dealing with right now. We'll look at the macroeconomic forces, the global political chess moves, and the nitty-gritty on-chain data that tells us what the so-called smart money is really doing. We'll cover strategies for my long-term investors, my mid-term swing traders, and yes, my short-term thrill seekers. By the end of this, you'll have a clear framework, actionable trade ideas, and hopefully a renewed sense of confidence. Or at the very least, you'll be intellectually entertained. Let's get into it. All right, first things first. To know where we're going, we have to understand where we are. Are we in a raging bull market, a soul-crushing bear market, or something in between? Let's look at the vital signs of the crypto ecosystem as of today, January 22nd, 2026. The total cryptocurrency market capitalization is sitting at a hefty $3.09 trillion. Now, that's a number that commands respect. However, it's seen a slight pullback of about 1.2% in the last 24 hours. This suggests some profit-taking or perhaps a bit of hesitation. The 24-hour trading volume is around $139 billion, which is substantial. It tells us there's a lot of activity, a lot of conviction on both sides of the trade. It's not a sleepy sideways market, it's an active contested battlefield. But here's where it gets interesting. Let's bring in the sentiment gauge, the crypto fear and greed index. Right now, it's flashing a score of 21. That, my friends, is firmly in the fear category, bordering on extreme fear. Just a few days ago, it was even lower at a chilling 3. For context, a score of 0 is extreme fear, meaning investors are overly worried, and 100 is extreme greed, where they're getting a little too euphoric. Historically, the legendary investor Warren Buffett advises to be fearful when others are greedy, and greedy when others are fearful. A reading of 21 suggests we are very much in the latter camp. It's a contrarian indicator that screams, hey, maybe everyone is panicking a bit too much. So, we have a high market cap, strong volume, but sentiment is in the gutter. What does this tell us? This isn't a straightforward bull or bear market. This is a high-stakes, high-volatility consolidation market. It's a market characterized by sharp news-driven moves, significant leverage, and a deep psychological battle between long-term conviction and short-term fear. The big players are accumulating, but they're also shaking out the weak hands with brutal efficiency. This is a market where you can get chopped to pieces if you don't have a clear strategy. It's a thinking person's market, not a blind ape-in market. Now, no market exists in a vacuum, especially not crypto. It's deeply intertwined with global politics and economics. Let's zoom out and look at the macro landscape, because this is where the big multi-month trends are born. First, let's talk about the elephant in the room, the US Federal Reserve. After a series of rate cuts in late 2025, the Fed is now expected to pause at its meeting next week. JP Morgan's research suggests they might stay on hold for the rest of 2026. Why does this matter? A pause in rate hikes or a stable interest rate environment is generally good for risk assets like crypto. It means the cost of borrowing money isn't going up, which encourages investment and speculation. The days of easy money aren't exactly back, but the tightening has stopped, and the market is breathing a sigh of relief. Next up, regulation. For years, this has been the big, scary monster under the bed for crypto. But in 2026, we're seeing the narrative shift. The Clarity Act is making its way through the US Senate. While it's currently on hold, the fact that it's being seriously debated is a massive step forward. We're even hearing from firms like PwC that 2026 is the year global crypto regulations become a reality. This isn't a bad thing. Clarity, even if it's strict, removes uncertainty, and institutions hate uncertainty. Ripple's CEO, speaking at Davos, even predicted a new all-time high for the market this year. citing this move towards regulatory clarity as a primary catalyst. And then there's the political dimension. The Trump administration has taken a surprisingly pro-crypto stance, with the president vowing to make the US the crypto capital of the world. They've even established a strategic Bitcoin reserve for seized assets. This is a 180-degree turn from the skepticism of his first term. This kind of top-down support, whether you agree with the politics or not, provides a powerful tailwind for the industry in the world's largest economy. So, what's the takeaway from all this? The macro environment is cautiously optimistic. The headwind of rising interest rates has subsided, and the regulatory fog is beginning to clear, with a powerful political tailwind pushing for domestic adoption. This backdrop supports the idea that we are in a period of accumulation and consolidation, not a bear market. The foundation is being laid for the next major leg up. The question is when? Okay, let's get our hands dirty and dive into the charts. We're going to break this down for our 3 types of traders. I want you to self-identify. Are you a long-term investor, a mid-term swing trader, or a short-term day trader? Your strategy, your time frame, and the indicators you care about will be vastly different. For my long-term traders, the investors, we're looking at the weekly and monthly charts. We care about the big picture, the structural integrity of the market. Right now, Bitcoin is trading around $89,000. It's up about 8% over the last week, but it's been a rocky road. The key level to watch is the previous all-time high. A sustained break and hold above that is the ultimate confirmation that the bull market is in full swing. From a technical standpoint, we're seeing some interesting signals. The Van Eck analysis from this month noted that Bitcoin's correlation to the S&P 500 has dropped to just 0.18, the lowest since October 2025. This is fantastic news. It means Bitcoin is starting to trade on its own fundamentals, decoupling from the whims of the traditional stock market. At the same time, its correlation with gold is rising, suggesting it's being seen more as a store of value, a digital gold. What should you be doing? This is a prime time for dollar cost averaging, or DCA. The market fear is giving you a discount. Buying into this fear, especially when the macro fundamentals are improving, is a classic long-term strategy. We're also seeing long-term holders standing pat. On-chain data shows that the supply of Bitcoin that hasn't moved in over 5 years is increasing. These are the diamond-handed OGs, and they are not selling. They are accumulating. Your strategy is to think like them. Ignore the daily noise, focus on the weekly closes, and accumulate on dips. A key trigger for you: a weekly close above the $95,000 level would signal a major breakout, and likely the start of a powerful move towards the psychologically important $100,000 mark and beyond. A drop below $80,000 on a weekly basis would be a caution signal, suggesting a deeper correction could be in play and a great opportunity to add to your position. For my mid-term traders, the swing traders, we're living on the daily and 4-hour charts. We want to catch the multi-week swings. This is where open interest and liquidations become our best friends. Total open interest in the derivatives market is currently $131 billion, down about 2.3% in the last 24 hours. This, combined with the price dip, suggests that some leverage is being flushed out of the system. This is a healthy sign. It's like a forest fire clearing out the dead wood. We saw a massive $565 million in liquidations over the past 24 hours, with over 139,000 traders getting wrecked. Crucially, the majority of these were long liquidations. This tells us the market is currently punishing overly optimistic leverage traders. It's a hunt for liquidity. Your strategy is to trade with the trend, but be patient. The current trend is choppy and sideways, so you want to buy at support and sell at resistance. Look at the Bitcoin open interest data by exchange. The CME, which is a proxy for institutional traders, has seen its OI decline by 3.3% in the last 24 hours. Institutions are being cautious. However, Binance, which is more retail-driven, has seen a slight increase. This is the classic smart money versus retail battle. A key setup for you: look for a sweep of the lows below $85,000. If the price quickly reclaims that level, it's a classic fake out or liquidity grab. This would be a strong signal to enter a long position, targeting the range highs around $92,000. Conversely, if we see a strong rejection from the range highs and open interest starts to climb as price falls, it's a sign that shorts are piling in, and you might consider a short position targeting the range lows. For my short-term traders, the day traders and scalpers, welcome to the jungle. We're on the 1 hour, 15-minute, and even 5-minute charts. We live and die by volume, order flow, and liquidations. Your dashboard should be coin glass. You're watching the liquidation heat map in real time. Those large clusters of liquidations are magnets for price. In the last hour alone, we saw $53 million in liquidations, with the vast majority being longs. This tells you the immediate pressure is downwards. You are a shark, and you are hunting where the blood is in the water. Your strategy is to be nimble. You are not marrying a position. You are on a brief, profitable date. Use indicators like the RSI, but use them on shorter time frames. The 4-hour RSI is currently a neutral 41.3, but on a 15-minute chart, you'll see it bounce between overbought and oversold multiple times a day. You can scalp these moves. Look for high volume nodes on the volume profile. These are areas where price is likely to react. A key trigger for you: watch the funding rates. When funding rates for perpetual swaps are highly positive, it means longs are paying shorts to keep their positions open, and the market is over-leveraged to the long side. This is a setup for a long squeeze. You can anticipate this by taking a short position when you see funding spike, targeting the next major liquidity pool below. Conversely, if funding goes negative and price is at support, it's a setup for a short squeeze. You are trading the mechanics of the market itself. So let's tie this all together. We've identified the market, analyzed the macro environment, and broken down the technicals. Now, how do you actually trade it successfully? For the long-term investor, your strategy is patience and accumulation. The current fear is a gift. Don't try to time the exact bottom. Continue your DCA strategy. Your thesis is that the fundamental adoption of crypto is growing and the macro environment is becoming more favorable. You are buying for 2027, not for next week. Your biggest risk is not volatility. It's being shaken out of a position that you know deep down is a long-term winner. For the mid-term swing trader, your strategy is range-bound trading with a bullish bias. The market is consolidating before its next big move. The macro factors suggest that move is more likely to be up than down. Therefore, you should favor long positions from the lower end of the current range, around $85,000 to $86,000, and take profits at the higher end, around $92,000 to $94,000. Use open interest as your guide. A sharp drop in OI on a price pump can signal the move is running out of steam. A sharp rise in OI on a price dump can signal a potential short squeeze is brewing. Be disciplined with your stop losses. In a choppy market, risk management is paramount. For the short-term day trader, your strategy is liquidity hunting and mean reversion. You are not concerned with the macro story. You are concerned with the order book for the next hour. Watch the liquidation levels on CoinGlass. Trade towards them. When a big level gets hit and price violently reverses, trade the reversion. Use a tight stop loss and take profits quickly. You are a sniper, not a machine gunner. One clean shot and you're out. Your goal is to compound small, consistent wins. Don't get greedy. In this environment, greed gets you liquidated. So there you have it. A market of fear and consolidation, but one that is underpinned by strengthening fundamentals and a shifting political tide. It's a market that will reward the patient, the disciplined, and the informed. It will punish the impulsive and the unprepared. Whether you're a long-term believer, a nimble swing trader, or a high-octane scalper, there is opportunity here. But it demands respect. It demands a plan. Don't just follow the herd. The herd is currently scared and confused, and that's when they make mistakes. Be the one who sees the structure within the chaos. And thank you for joining me on Boni's Life. I hope this has brought you some clarity. What are your thoughts on the current market? What are your go-to strategies? Drop them in the comments below. I read every single one. And if you found this valuable, do me a favor and hit that like button and subscribe. It tells the great YouTube algorithm that we're doing something right over here. Stay sharp, stay curious, and as always, trade smart.